Welcome. Thanks for watching another video. It's been a while. I've been out traveling and now I'm back here making some more videos. So in this one, I'm going to go through some, I don't want to say tax planning tips, but just some things to kind of look out for. You know, we all put our money in these high interest bearing accounts. Why wouldn't you? You know, rates were 5% plus, those I bonds were at 9% plus. So, very little risk, high reward, but now we got to pay taxes on this interest income that we earned this year. So we got another 4 more months before 2023 ends, and there's some things that you could possibly do, but if at a minimum, just kind of educate yourself on the taxability of these accounts. And at the very end of the video, I'm going to walk through a tax return, as I usually do, the tax forms that you'll expect to get, and maybe something that you can do before the end of the year to kind of save on taxes here. So if you have any questions, leave them in the comments below. Thanks again for watching. All right, so I'm going to go through 4 slides here, and then I'll go through a quick tax return. The whole purpose of this video here is, a lot of individuals out there took advantage, and rightfully so, of these high interest rates in 2023 that these banks were offering. Treasury bills, other fixed income investments. And, why not, right? You had guaranteed high, returns on your investment, savings rates at banks, 5% plus. I bonds at one point were 9% plus. It's kind of like a no-brainer, right? But now we got to face reality. In some of these vehicles, there's taxes that we got to, pay on. So, for example, in the year 2023, you're going to end up earning interest income of $4,000. You're in the 32% tax bracket. That's an additional, $1,200 of tax that you're going to have to pay that you probably haven't budgeted. So it's things like this that you want to think about right now. And all this interest that you're earning, it could move you to like another tax bracket. So, the types, there are I bonds out there, CDs, high yield money market accounts. I'm going to go through some of the, big ticket items out there and just let you know whether they're taxable or not and what to expect at the end of the year. So I bonds, those are the ones that, where the Treasury website crashed. Everyone was trying to get out there. That was, October of 2022, I believe. So the interest on those, there's no state and local tax. Okay. So when you earn interest on those, you're not going to pay any interest at the state level. At the federal level, you will once you cash them out. So, they're going to be in here earning interest, but you're not going to pay tax on them until you cash it out. Now you could go in there and say, you know what, tax me on an annual basis. You're paying taxes now instead of this big lump at the end of the year or whenever you plan to cash it out. CDs, certificate of deposits, interest is taxed as ordinary income, federal and state level. Okay. And you'll get a tax form in the mail from your bank. And by the way, we tell all of our clients this, but don't expect to get something in the mail, right? A lot of these banks, are going paperless. So you got to log into your bank account, typically in January, toward the end of January, and all your tax forms are going to be there. So we've seen instances where people have not received tax forms in the mail, tax returns are filed, they get a letter from the IRS. So just word of caution, you always want to make sure you have your login to your bank investment accounts. So money market accounts. It depends what kind of money market, funds you have. There's taxable money market funds and there's tax-free money market funds. So you want to know where you're putting your money. It's not necessarily better that it's in a tax-free money market fund. Maybe a taxable one might, have more options for you. It might be a better performance than a tax-free. So just know what type of, money market fund you have. Treasury bills, there's no state or local tax on interest earned, but at the federal level, taxes due as interest payments roll in each year. Now, this is a recommendation, and I highly recommend doing it. If you go to the Treasury website, if that's where you bought the Treasury bills, you can elect tax withholding. What that means is kind of like your paycheck, right? Every time interest is being earned, there's money being set aside for taxes that essentially is going to be paid. So if you're going to earn like $100, maybe $10 is going to be withheld. So you're going to collect $90 and they're going to submit that $10 for you. So you don't have to like make an extra payment. And I would recommend this for these high interest bank accounts. I personally do this. You can elect withholding, tax withholding. So when you get your 1099 INT form, and I'll show you this right after this clip here, what it's going to look like on the tax form. So what's going to happen is, like, if you have money at Ally Bank, you can elect this tax withholding. You can tell them, hey, Ally, withhold taxes, for my interest income. So if I was going to earn like $7,000 of interest income during the year, they're going to withhold maybe 10% of that. So $700, they're going to pay on my behalf to the IRS. So when I get that tax form, I won't have to do anything, meaning that they've kind of already paid what I needed to pay. So I recommend that, especially those that are earning, high interest income during the year. And then municipal bonds, generally they're tax free. However, you want to check the states where you have these bonds in, because every state is different. And I can kind of give an example here where, just say you live in Oregon, but you have an Illinois bond, you're going to have to pay tax on that in Oregon on that Illinois bond. Now, if you live in Oregon and you have an Oregon bond, you may not have to pay federal or state tax. So just make sure you check the state rules, because they're all very different. Okay, now I'm going to go into tax return and the tax form, just kind of show you a quick example. All right, so the last part of this is to kind of show you this interest income and kind of where it shows up on the tax return. So going back to our couple here, Ferris and Sloan, they have taxable income of $188,000, and you can see here taxable interest, right? Line 2B, there's nothing there. Okay. Now what we're going to do is we're going to say, all right, they put all their money in Ally Bank this year. Ally Bank, let's change this up here. Ally Bank. And they, at the end of the year, at December 31st, 2023, they get this 1099 INT. Okay. And it's going to show interest income of $7,500. So now let's recalculate the return, and I'll show you, well, first, let me go back. I'll show you where they ended up, and you'll be able to see the tax impact of this interest income here. So the taxable income, right, 188, and at the end of the year, they had a small refund of about $1,000, okay? So now we're going to go back. We're going to say they had $7,500 of interest income, right? And we're going to recalculate. Let's see how that changes everything. So go back to page 1. You can see right here, here's the $7,500, right? So this is going to add to their total income, which is going to be subject to tax, okay? You can see their taxable income increased by that $7,500. We go down now, instead of getting a refund of $1,000, now they're going to owe almost $800, right? So they went from getting a refund of $1,000 to now owing $800. So that's like a swing of $1,800 by this interest income here. So that's why, and a lot of people are going to be getting, these high interest income, they earned that this year, right, by having all this cash in the bank. So what I mentioned about having the banks withhold for you, that's a good option. So you're not going to be shocked at the end of the year. So just say, we say, all right, the bank's going to withhold, let's call it $7,500 or $750, 10% of the interest income. Now let's recalculate, okay? And you still got that income, right? That's not going to change. But then we go down here, and they're going to owe a little bit. But remember, they've already paid in that $750. They personally haven't, but the bank has withheld that. And you can see it right here, right? So the bank withheld it. The bank paid it on behalf of Ferris and Sloan. But now Ferris and Sloan, they're not going to be shocked with, some tax liability at the end of the year. So if you have the opportunity to do it, I recommend you there is that thought process out there. Well, I could be using that money elsewhere and making more money. Yeah, technically you could, but if your money is just sitting in the bank account earning interest and you're going to have to pay tax on that, you might as well withhold it. Now, you might have some other, um, you know, tax loss harvesting, which right here you can see they did, and they max out. You can max out at $3,000 a year. So they already took advantage of that. What this does is it essentially kind of reduces your taxable income. Um, so, so they've already taken advantage of that. So anyways, just something to think about, but you can see here the impact of this tax. And again, for, the year-end tax forms, it's the 1099 INT you're going to be looking for. Okay. And that's where a lot of this interest income is going to be reported. Now, if you have money in an investment account, say it's like Charles Schwab and you got investments and stuff, dividend income, and you might have some money earning interest there, it's going to be on like a composite document. It's going to be a 1099 form, 1099, 1096. And it's going to have interest income. It's going to have dividend income. It's going to have all your gains and losses kind of broken out for you. So, yeah, thanks again for watching. If you have any questions, let me know. Thanks.